Can you see this Excel file, please?
Yes.
Okay. So I ask you to, we did a calculation. The treasury bill is issued for 182 days with a yield of 6%, and we calculated what was the price. Then we did at different time. If the yield changes, goes up and goes down, what would be the prices? So I ask you to do it for several days and several yields. So this is the this is what I did. So the face value is 100, yield 6%, number of days to maturity at the beginning 182 days, and then the price is 97.087. So with the time, when the days to maturity goes down, that means it getting closer to the maturity, what would happen if the yield remains unchanged? Yield was at 6%, and time passes. Then what would happen? So we bought it, or at the issuance, the price is 97.08. You know, on the maturity date, you get 100. Therefore, on the maturity date, it should reach 100. So then price should go up gradually if the yield remains unchanged. So you can see in this row, price increases from 97.08 to 97.24 in just 10 days, 97.24 to 97.39 in another 10 days. Likewise, price increases gradually when it getting closer to the maturity, and when the remaining time is 0, that means on the maturity date, price is 100. So then what would happen if the yield is increased 6.1? So this at the time we buy, if we assume the yield is 6%, after that yield increases to 6.161, then you can see the price is 97.19, 97.35. Still price has gone up, but compared to the yield of 6%, price is lesser than that, but still it reaches 100 on the maturity date. So what would happen if yield decreases? Then you can see a higher price, but still again it is increasing until maturity. Say instead of 6.10 or 6.1, what would happen if we increase the price to 6.25? You bought it at 97.08. After 10 days, it is 97.13. So only a 5-cent increase. If we increase this to 6.5, you can see price is lower than your purchase price after 10 days. Likewise, depending on the interest movement, you may incur a profit or loss during the lifetime of a treasury bill. Not only treasury bill, this is even true for treasury bonds as well. We'll discuss when it comes to fixed income securities. So this is what I ask you to do. Try these different combinations and see what would happen. Even in the previous case, 6.25. Give me a second. So if the yield increases to 6.25, say now 50 days gone from the origin, that means we are here. But what is the rate of return? If the yield remains at 6%, what is the rate of return? But what would be the return if the yield has increased to 6.25? You would see a lower rate of return for this 50-day holding period return. So, but if you do the same thing when the yield is 5.9, your return may be more than what you get here. You can do that calculation as well, assuming you bought it at 97.08. Try these different combination and try to understand the relationship between yield and the price and the timing, and then the realized return, holding period return as well. So you have to do these things by yourself, then only you can get to know more about these things. Don't wait for someone else's to do. It won't give you anything. When you do these things, maybe in Excel or maybe in a calculator, or you write something on a piece of paper, then only you will come up, or you will find few problems, what to do, how to do, what is this, and kind of thing. Even though you know the equation, you may find some difficulties when you really try to apply these things. So therefore, you do it by yourself and come up with problems, then try to find the answers to those problems. So that is just a continuation or the revision of last week. Is there any question about these money market calculations? Because today we are going to move into foreign exchange, the hot topic. We are going to move into that topic. Money market calculation is that session is over. So if you have any questions, please ask now. Any questions? No questions. Okay. You might have noticed that there was a small problem in the money market handout. Can you remember? I edited it and corrected that technical issue. In one of the examples, the question was not completely appeared on the slide. Yes, this one. I think this one. This was not properly appeared. So I amended it and uploaded it. Please check it again. And the other thing, have you noticed this? This is also uploaded. There are practice questions, and you can see the relevant topic. So you can try these questions by yourself. Don't wait until uh, the end, somewhere in October or November. Do it now and come up with any questions you have. Okay. Any questions? If you don't have any questions, may I start with foreign exchange? Is that okay? Any questions, please? Any questions? No. Okay, then I hope you can see the presentation. Is it?
Yes.
Foreign exchange. What is foreign exchange? Why do we need foreign exchange? And what are the economics behind that? We'll touch a little bit on that. Then we'll move into different type of calculations, different type of rates that we calculate. Then we'll move into one of the derivative products related to foreign exchange, forward and swaps transaction. We will discuss under this foreign exchange topic here without waiting for derivatives module. But you will get some understanding about derivatives through this forward and swaps transaction in foreign exchange. So in the first foreign exchange one module or the topic, we are going to basically get some idea and introduction to the foreign exchange market. Then what is the organization of the FX market, especially in countries like Sri Lanka, and what are the jargons that are used in the foreign exchange market. The focus is to get the basic background, basic understanding on the foreign exchange market. So the first thing is, why do we need foreign exchange, and what is foreign exchange? Any idea? What is foreign exchange?
It's a local currency converted into a foreign currency.
Yes, you can say it's the yes. When you say foreign exchange,
Yeah,
you convert local currency to
a
foreign
foreign currency.
foreign currency, or it can be other way around as well.
A foreign currency to a
Foreign
local.
currency to local currency. Yes. Okay. Why do we need foreign currency? Basically, foreign exchange means foreign currency. So yes, or the exchange of two currencies, we can say like that.
Yeah,
Uh, why do we need foreign exchange or the foreign currency?
for imports and exports purposes.
Basically for export and imports. Why do we need foreign currency in export or import? Why can't we do that just in rupees?
Because our local currency is not a designated currency. So, like,
Yes, it's like this. So here, say Sri Lankan manufacturer produce something and export it. Say the buyer is in German. Does the German buyer possess any Sri Lankan rupees? In German, what is the currency they use?
Euro.
Euro. Yes. So they use euro. We use Sri Lankan rupee. So can we ask them to pay in rupees? It is difficult because in those countries, rupees is not available, and legally you cannot take rupees outside to other countries, and you cannot use rupees for transactions in any other country other than Sri Lanka. But there are some currencies, even though the legal tender is their domestic currency, like euro or US dollar, that currency is accepted by many other countries. But if we take Sri Lankan rupees to German, they won't accept Sri Lankan rupee and give you euro. But if you take dollars to Germany, they will accept dollars and give you euro. You can exchange that. Okay, assume even say a trade between US and European country. US within US they use US dollar. In European region they use euro. But still, if you want to settle the transaction between these two countries, how do you do? If the importer is US and the exporter is in Germany, then how do you settle it? Either German firm has to request from the US firm to pay it in euro or pay it in dollars. Either way can be done. Then if it is the case, the German company asks the US firm to pay it in euros, how the US firm get euros? They are in it's in US and use US dollars. Then that US firm should be able to convert its own US dollars to euro and make the payment in euros to the exporter in Europe. Or if it is the other case, European firm agrees to accept the payment in US dollars, fine. US party can easily pay that to the European party. European party will collect euro, but still, sorry, European party will collect dollars, but can that party use that within European region? No, he cannot pay his labor cost or raw materials within the region in dollars. Then that exporter has to convert whatever the receipt of US dollars into euros. Similarly, even in Sri Lanka, countries like us, our currency is not acceptable to the other countries. Basically, we have to invoice most of the things in foreign currencies, either in US dollars or euros or Japanese yen or that type of currency. So assume we invoice it in dollars, then US firm, it is easy, they can pay it in US dollars. But the exporter in Sri Lanka incur most of the costs in Sri Lankan rupees. Then what they have to do, they have to convert that US dollars to rupees and get funding for their requirements. So that's why we need foreign exchange market. That's from the exporter's side. If you want to import something, what do we do? Say, as given in this example, we import vehicles from Japan. Japan, they accept Japanese yen, but in Sri Lanka, we don't have Japanese yen. We have to go to a bank and buy it. We have rupees, but as an importer, we have to pay it in yen. So we convert our rupees into yen. So around the world, this is a necessity because various countries use various currencies, but they trade among themselves. So somehow they have to make the payment to other party and accept payments from other parties and maybe in different currencies. Then they have to convert one currency to another currency. Say for another example, maybe we are sending goods, say to Europe, but our exporter wants it in dollars. Okay, forget about Europe. Say we are sending goods to India. In India, they use Indian rupee. In Sri Lanka, we use Sri Lankan rupees. Sri Lankan firm, will it accept Indian rupee? Or Indian firm, is it possible Indian firm to pay it in Sri Lankan rupees? No. Then we will go for a common currency like US dollar. Sri Lankan firm invoice it in US dollars. So therefore, Indian firm has to pay it in US dollars. So then at their end, they will convert Indian rupees to dollars and make the payment to the Sri Lankan party. At this end, that dollars will be converted to rupees. So why do we need this? To facilitate the international trades. So that's why we need foreign exchange. That is the basic origin of foreign exchange transaction. But nowadays we use that foreign exchange transaction for many other purposes. So all these explain that concept. We need foreign exchange, or we should be able to convert one currency to another currency to facilitate imports and exports, maybe goods or maybe services, or even yes, you go for a visit in another country, then you need currency of that country. but maybe you cannot get that currency. Say if you go to China, you have to buy dollars from here and go there, then convert that dollars to yuan when you arrive China. The Chinese comes to Sri Lanka, they may buy dollars from that end, come here and convert it into rupees. Likewise, to facilitate those things, trades, we need this foreign exchange market. So that is the basic of the foreign exchange. What is foreign exchange and why do we need foreign exchange market? Okay, where is the location of this foreign exchange market? Is there any particular place? No. It is all over the world. Within Sri Lanka, we convert many currencies into rupees or rupees into many other currencies, basically dollars, euro, yen, likewise, even Middle East countries, currencies. If you go to a major financial center like London, New York, Sydney or Tokyo or Singapore, even Singapore, they convert many currencies into another currency. So trade in very big volumes, high number of transactions. So therefore, there's no particular place to transact or do these transactions. And there's no time restriction indeed. It's 24 hours. Only restriction is general thing is Saturday and Sunday there won't be FX transaction, FX market opens because those are holidays. Otherwise, from Monday to Friday, Monday Sydney opening time around 7:30 in Sydney, market opens until 5:30 in Los Angeles in Friday. So until within that period, foreign exchange market is continuously operate. It's a 24-hour market and it is highly liquid. What does it mean, highly liquid? There are a lot of transactions taking place. Volumes are high. You can do a transaction without having any bad adverse impact into the market because there are so many buyers, there are so many sellers in many currencies, not each and every currency, but many currencies. There are a lot of buyers and a lot of sellers, and you can trade in those currencies. But if we take a particular country or a particular country, in that country also foreign exchange market be the most liquid market compared to the other markets. It can be bond market or the share market. Compared to those, foreign exchange market would be the most liquid market even in the domestic context. Even in Sri Lanka, until very recently, foreign exchange market was the the most liquid market. So then the other point is foreign exchange market is a over-the-counter market. Can someone tell me what does it mean by over the counter? What does it mean by over the counter market? We discussed this at the very beginning, one of the sessions at the beginning. Can someone briefly explain what is an over the counter market? Anybody? So then I'll keep it for you. You can go back and refer the previous handouts. You might have noted down what is a over the counter market when I explain, or go back and watch that video and find out what is an OTC market. So what we discussed so far is foreign exchange market. Why do we need foreign exchange? And other characteristics of foreign exchange market. So basically we need foreign exchange to facilitate international trade, to finance international trade, because various countries use various currencies, but they do transaction among themselves, not only trade. Investors invest in foreign currency for foreign countries. Say, US investors may invest in Sri Lankan government bonds. Japanese investors may invest in Sri Lankan bonds, or Chinese people may invest in Africa. Indian people may invest in somewhere else. Likewise, European people will invest in UK as well as US, and maybe countries like Sri Lanka or Taiwan, Thailand. Likewise, you might have seen that very recently in Shane Warne. He dies in his own resort in Thailand. That is an investment, an Australian made in Thailand. So likewise, but when he made that investment, definitely he had to convert US dollars or the Australian dollars into Thai baht to make investment. So likewise, there are foreigners, those who have invested in leisure sector in Sri Lanka, in hotels, maybe related things in that. So they bring dollars here, convert it into rupees and make the investment. There are foreigners, those who buy shares in Sri Lankan market, Sri Lankan government bonds. They bring dollars, convert it into rupees and make the investment in rupees. So to facilitate all those things, we need to convert one currency to another currency, and that transaction is an over-the-counter transaction. And globally, the market is open 24 hours, and it is the most liquid market. Volumes are very high, maybe trillions. Globally, it is 24 hours, but if we consider a particular market, domestic market, it may be vary. Say for an example, in Sri Lanka, our market is open from 8 to 5 every day for an exchange market. We don't have a night market. We have a daytime foreign exchange market only. But around the globe, it is 24-hour market, generally starting from Monday to Friday. Monday morning, Sydney time, 7:30 to Friday evening, Los Angeles closed. Until that, the market is open, but there is a small exception in Middle East countries because their holidays are not Saturday and Sunday. There are countries they take the holidays Friday and Saturday. So therefore, they are in those countries. Sunday is a business day. Therefore, foreign exchange market is open in these uh, or the Sunday in these countries. That's the only exception. Other than that, generally Monday to Friday is the opening hours. There's no physical location for foreign exchange transaction. You can do it over the phone. You just call another bank and enter into the transaction, or you can use an electronic platform or maybe an app. There are many ways that you can do the transaction within very few seconds. That's the basic. So now we'll move into the organization or the mechanism of foreign exchange market. Now with that, you may be able to understand what's happening now in the market. I'm going to discuss this initially basic concept and then how Sri Lankan context it works. So as I mentioned, there's no physical location or centralized location. It can be anywhere, but it's a global network of participants. They connected each other one or the other way, maybe over the phone, maybe through electronic trading platform. So they communicate to each other. Prices are available, information available. They gather those information and take decision and do transactions. The most important thing is there's no centralized or single physical location. It's all over the world. Then who are the participants? So we discussed that foreign exchange, the requirement of the foreign exchange market token. Why do we need to convert one currency to another currency? This is to facilitate the trade, international trade. That means exports and imports. So therefore, in the market, participants, major participants are exporters and importers. Either they want to buy foreign currency or they want to sell foreign currency. Then again, that exporters or importers, they can be corporate or individual. Exporters and importers, they buy sell foreign currency, but the thing is again, they cannot do it among themselves. Say in Sri Lanka, there can be an importer and there can be an exporter as well. The dollars the exporter receives, he wants to sell it and get rupees. On the other side, the importer, he wants to buy dollars, but would that transaction be happen between these two parties, importer and the exporter? Exporter may not be able to find a suitable importer. Importer may not be able to find a suitable exporter. Those who have in that volume, the same amount, and so therefore it is difficult. In that again, banks comes into the picture as an intermediary. Exporter can go to a bank and say, okay, I have this much of dollars, I want to sell. Bank will accept it. Bank will buy it from the exporter. Meantime, there can be an importer comes and say, I want to I have import and I have to make the payment. This is the amount. Then the bank say, okay, we'll give you. Bank will sell dollars to the importer. So the banks come into the picture. Then the thing is, even the customer comes and asks from a bank, the bank may not have sufficient dollars. The bank cannot turn down the customer. What would be the action of the bank? The bank may try to find that required dollars from another bank. So therefore, this interbank market comes into the picture. We will discuss this in a later slide in detail. So there can be foreign exchange. There are foreign exchange transactions between banks, among banks within the same market. To facilitate that, the brokers comes into play. Not only that, even to the individual level, there are brokers. To individual customers also there are brokers, and countries like us, we have introduced money exchanges especially. So they are not in the banking business, but they sort of a intermediary in between individual customer and the bank. The money exchanges, they can buy foreign currency from individuals and hand it over to the bank, transfer that amount to the bank. And then comes the investors and speculators. Why? So depending on the demand and supply of exporters and importers, the thing that you call the exchange rate, will come to that later. What is exchange rate and thing? We'll explain in detail. The exchange rate changes. So when it changes, the value of one currency increase or decrease compared to another currency. So if you can predict that moment accurately, you can make money. So that's what these speculative traders do. They forecast currency movements. And try to capitalize on that forecast, make money. Short-term gain, they try to get short-term gains with the movements of foreign exchange. Prices change almost like every second, so therefore you can make money. So this may be the most active participants in the market these days. They make money. I'm referring to the global perspective, not the domestic context. Domestic context, speculation is not allowed for individuals. And the investors, these are the investors I mentioned earlier. So portfolio investors, foreign parties, or people invest in other countries. It can be a firm, or it can be individuals, or it can be fund managers. They invest their wealth in various countries. So again, they need to convert one currency to another currency. So they play a major role, or they are major participants in the market. Then central banks also. Central banks again participate in two different ways. One is as the reserve manager of the country. They manage for foreign exchange reserves of of the country, and they invest it in foreign currencies. Then they may have to convert, depending on their views and requirement, convert one currency to another currency. The important thing is both are two foreign currencies, not the local currency. As reserve managers, like sort of investor, they at that time in central bank plays the role of an investor. Central bank make investments in foreign currencies. So therefore, need to access the or participate in the foreign exchange market. That is happening. On the other hand, in the domestic market, to maintain the exchange rate at a particular level or to curb the volatility of the exchange rate or the foreign exchange market, time to time, they may have to intervene in the foreign exchange market, domestic market. So then they do the transaction against their domestic currency and one of the foreign currencies. Say in Sri Lanka, it would be dollars and Sri Lankan rupees. So central banks participate in the foreign exchange market in two different ways. So now we'll move into or try to understand what's happening in a closed market like Sri Lanka, and how the exchange rates goes up and down, and how this can happen in the market, especially what is this interbank market. So assume there are four banks. There are four banks in the system, only four banks. So we can start with an exporter. Exporter receives dollars from its counterpart, the importer in overseas. He receives dollars. As we mentioned earlier, at least part of these dollars has to be converted to rupees to meet its expenses in the domestic market. Wages will be paid in rupees, raw materials purchased locally are paid for those paid in rupees. So likewise, there will be expenses in rupees. So therefore, the exporter needs to convert that dollars into rupees. The exporter will go to a bank and sell that dollars to that bank and buy the local currency. Then the bank gets that dollars into its possession or onto its balance sheet. Then is there any risk if the bank keeps it in its balance sheet? Yes. If the exchange rate changes, it can be a profit or a loss. So therefore, bank does not want to keep unnecessary amount in its possession. So in that instance, when they have more than enough or more than allowed amount in its possession, it would try to pass that amount to another party. So that bank may call another bank, say this is bank A. Bank A may call bank B and ask for a price. Then the bank B has to give that price for say dollars. Then bank A can sell that dollars to bank B if the price is agreeable to both parties. Then bank B receives that dollars. Then again bank B also thinks, okay, there is a foreign currency inflow. So therefore, the domestic currency may appreciate. I should not hold on to this. I should sell this to someone else. Bank B may call another bank and try to sell this. The bank C. Bank C also may think like that. Call another party, Bank D. Bank D again try to sell it. Maybe it will come back to Bank A. Likewise, this will go in circle within the banking sector among banks. So this part is the interbank market. Transactions taking place within the bank. So what would happen? This circle is going on. So they see banks are selling dollars. What does it mean? Supply is there. Then what would happen to the domestic currency? There is a foreign currency supply. What would happen to the domestic currency? Domestic currency value will go up. Value will go up. So that would happen until a importer comes and buy it from the from a bank. So take that dollar amount out of the system to make a payment to a foreign party. This will create the demand. This will give the supply. So until this supply and demand comes to an equilibrium, the price will fluctuate. So this is only the one side. So starting from exporter to import, it can be other way around. Start from the importer. Importer comes to a bank and asks dollars. Okay, bank sell dollars to that party, but bank needs to get that dollars. That bank may call another bank and try to buy dollars. Likewise, the buying pressure can go around the banking system, around the or in the interbank or foreign exchange market. Then they see there's a buying. Everybody is trying to buy dollars. That means that creates demand. Then what would happen? Value of the domestic currency goes down because there's more demand for foreign currency. Value of the domestic currency goes down. That will stop only when exporters are selling in the market to meet that demand. That's how when the flows are coming to the market, maybe from buying side or selling side, the exchange rate fluctuates up and down. So it should not only be exporters, that can be other investors. Those are bringing foreign currency to the country. Maybe like when we say export, even tourism, we can consider it as export. So likewise, there should be foreign currency inflows to the system, and there will be outflows as well. Where is the balance comes when the supply and demand matches each other. Until such time, as you know in basic economics, supply and demand will decide the price. When the demand is high, price will go up. When the supply is high, price will go down. This would happen in the market continuously. So this is the basic of the interbank market. Then thirdly, what would happen? Central bank may comes into the picture if the market is highly volatile or the exchange rate or the domestic currency depreciate or value goes down drastically, and it is not good for the markets, or it's not good for the stability of the market. Then central bank may come to the market and either buy from the market or sell to the market to maintain the volatility in the exchange, foreign exchange market. So inject means sell foreign currency from its reserves. Central bank sells foreign currency to the domestic market, and the bank will have to pay in rupees. The rupee goes out from the system to the central bank, and foreign currency comes into the system. Absorb means buy. Buy from the system. Then the rupee will come to the market, and foreign currency will go to the move out from the system to the central bank. So central banks do this sell transaction when there is a lot of buying pressure in the market. When there is a lot of selling pressure, central bank will come and buy in the market. So that's how the foreign exchange market works in a country like us. So the transaction among banks, we call it as the interbank foreign exchange market. So any question? Any question?
So in these days, also central bank buy dollars from the market, foreign currency from the market. My opinion is that due to that supply pressure, or to just maintain the reserve.
It can be both. Yes. So when there's a more supply than the demand in the system, for exchange or the rupee start to appreciate drastically. So if central bank thinks it's not that good, then the central bank buys from the market. When central bank buys it from the market, that foreign currency is added to the reserve. So the reserves will be built up. That's what happens. When central bank sells in the market, reserve level goes down, and the market will get foreign currency. Did I answer the question?
Yes, sir. Thanks.
Anything else? Okay. If not, we'll move to the terminology. So what are the words that we use in exchange market? Anything that you know? Special words used in foreign exchange market?
Tom cash spot.
Yes. Tom. Cash. Spot. What else?
Direct quote, indirect quote.
Direct quotes, indirect quotes.
Long and short positions.
Direct quotes, indirect quotes, long, short, What else?
Net open position.
NOP, net open position.
Then
Then-
net overnight open position.
Sorry?
Net overnight open position.
Net overnight open position. Yeah, it's a breakdown of this.
Yeah.
Bid offer.
Position, bid offer. What else?
Premium. Forward.
Premium. I don't know what's happening there. Premium. Forward. What else? Socks. Have you ever heard? Should be. What else? Cross currency. Have you heard that? Okay. Yes, these are some of the or most of the things that we are going to discuss in the coming slides. First, we'll understand what is the exchange rate. That's the very common terminology. That exchange rate. What is the exchange rate? It is, I think this is the best. The value of 1 unit of a one currency in terms of another currency. Exchange rate is a price. Price of one currency in terms of another currency. That's the thing. That's it. So if you go to a boutique and try to buy something, say, okay, 1 kilo of rice. The commodity, the good is rice. The amount is 1 kilo. The price is 125 rupees or 150 rupees. So the commodity is something tangible or something that you use. The price is in one currency. Here also in foreign exchange also, foreign exchange rate is a price, but price of another currency. That's the only difference. Instead of price, say it's yen. What is the price of a yen in terms of rupees? If you want to buy 1 yen, how much you have to pay in rupees? To buy a 1 yen, how much you have to pay in rupees? Or if you want to sell 1 yen, how much rupees will you get? That is the exchange rate. So whenever we say exchange rate is this much, definitely you have to say what is the two currencies involved. Say like if you go to a boutique and say the price is 125, is there any meaning? The price is 125. Is there any meaning?
No.
You don't know price of what? Likewise, even if you say exchange rate is 200 rupees, it's not having a particular meaning. There can be implied thing, but to make it clear, you have to give the currency pair. We call currency pair. What are the two currencies involved? You can say dollar exchange rate is 265 rupees. So then you know the exchange rate of dollars in terms of rupees. If you say dollar is 120 yen, that is the exchange rate between dollar and yen. So therefore, exchange rate, it is a price of one currency in another currency. So whenever you say the exchange rate, you have to mention what is the two currencies involved. Clear? If you get it in that way, then the rest would be easy. Don't get panic or mess up or take it serious with this exchange rate. It is nothing but a price of one currency in terms of another currency. What we have get used is to give a price of a particular good or service or a commodity in terms of a currency. But in this instance, the commodity or the good itself a currency, and we give the price in another currency. That's it. Whenever we say 1 JPY equals 1.35 LKR, generally we write it like this. JPY LKR is 1.35. So that is the exchange rate between Japanese yen and Sri Lankan rupees. So before I move, I'll explain this. So you know, according to the ISO standards, each currency is denoted by 3 letters. So LKR is the 3 letters given to Sri Lankan rupees. JPY, Japanese yen. So basically, most of the time, first two letters to indicate the country, and the third one is the currency. JPY is for Japan, Y is to yen, Japanese yen. LKR, Lanka rupee. Then if we go to our neighbor, it is INR, Indian rupee. What other currencies that you know? US dollar. This is sort of exception. Euro, the currency region is also European region, currency also Euro. So the 3 letters are also EUR. GBP. What does it mean? GBP. What is this currency? GBP.
Sterling pounds.
Sterling pound. So where's that sterling part here?
Great Britain pound.
This is Great Britain pound. That's the official word. Yes. Generally we call it sterling. We have nicknames. Sterling is sort of nickname. For USD, the nickname is greenback. Because if you take the dollar note, one side is slightly greenish. So that's why they call it greenback. What is this? AUD. AUD, this is Australian dollar, SGD, Singapore dollars, CNY, what is CNY?
Chinese yuan.
Chinese yuan. So likewise, for any currency, there's a 3-letter code to denominate it. So be familiar with those as well. You read markets, then you will come to know about these as well. So, however, what I wanted to highlight here is what is the exchange rate? It is a price of one currency in terms of another currency. So the commodity is a currency and the price is given by another currency. Then, since we have two currencies, how do we know price is given in for what currency and which currency? So there should be a distinguish between that. If you write it like this, yes, it is clear. One Japanese yen is given in 1.35, or price of yen is given in rupees. So based on that, we distinguish these two currencies. One is base currency, the other one is counter currency. The base currency is the currency of which the price is given. So in the previous example, 1 JPY equals 1.35 LKR. One yen is equal to 1.35 LKR. So the price of yen is given in LKR. So we call this yen as the base currency. And the currency in which the price is quoted, we call it the counter currency. LKR is the counter currency. The price is quoted in LKR. Price of yen is given in terms of LKR, then yen is the base currency, LKR is the counter currency. Clear? Is it clear, the definition? So this is something that you should know very well. Don't get confused with that. When we move forward, we just use the base currency and counter currency and discuss a few other concepts. By that time, you should know what does it mean by base currency and what does it mean by counter currency. Any question? Is it clear? Let's see. So in these pairs, what are the base currencies?
USD, Euro, and AUD.
Yes, USD is the base currency in this pair. Euro is the base currency in this pair. Even here, Euro is the base currency. This one again USD is the base currency. The last one AUD is the base currency. So if I draw a line here, generally in this way of expressing the exchange rate, what is in the left hand side or the first, that is the base currency. But remember, you might see sometimes this is written as USD LKR. This is bit confusing because sometimes you write it this way, sometimes you write it as this. So then it will be bit confusing. However, this one we read as LKR per USD. LKR per USD. So, but sometimes in some, this one is written also as like this USD LKR. So then you have to have some idea about the number and the based on the market, you should be able to identify what is the way that is given. But in this way, there's no confusion. Very straightforward. The first currency is the base currency. Then what is the counter currency? What is on to the right? These are the counter currencies: LKR, GBP, dollar, yen, dollar. So again, another thing that you have to notice, say in two pairs, dollar is the base currency. But there are another two pairs where dollar is the counter currency. But euro is base currency always. So we'll come to that later. So therefore, depending on the currency pair, the way we generally express the exchange rate may vary depending on the currency pair. So you should be able to identify what is the base currency and what is the counter currency. And with that, you should be able to interpret this number. USD LKR 130.5. What does it mean? How do you read this?
1 USD is equal to 130.50.
1 USD, yes, 1 USD equals to 130.5
0.
LKR, Sri Lankan rupees. How do you read the second one?
1 euro is equal to 0.811 to sterling.
Yes, 1 euro is equal to 0.8112 sterling pound or Great Britain pound. The second one, 1 euro is equal to 1.3674 US dollars. The fourth one, $1 is equal to 101.96 yen. The fifth one, 1 Australian dollar is equal to USD 0.9238. So likewise, when you see this, you should be able to identify the base currency and the counter currency and interpret the exchange rate properly. If you can't do that, then there will be a problem moving forward. Is it clear? Any question? So one of you mentioned that direct quote and indirect quote. That is related to this base currency and counter currency in the quote. So the original definition comes like this. When we say it is a direct quote, the way we express the exchange rate is a direct quote. when the number of domestic currency units per one foreign currency unit is given. That means number of domestic currency units per one foreign currency unit is given. That means domestic currency is the counter currency, foreign currency is the base currency. When the foreign currency is at the base currency and the domestic currency is at the counter currency, we called it as a direct quote. But this definition, there's a small problem. Say, for example, if we take this currency pair, what is the foreign currency? What is the domestic currency? For us, both are foreign. Dollar is foreign currency for Sri Lankan, yen is also foreign currency for a Sri Lankan. So then how can we distinguish based on the original definition that domestic currency and the foreign currency? It is difficult. So, okay, again, for a US citizen, what is the domestic currency?
Dollars. US dollars.
US dollar. Foreign currency is yen.
Yeah.
Then the domestic currency in terms of foreign currency. Then it won't fit to this direct quote definition. But if you take a yen investor or the Japanese person, then dollar is foreign currency, yen is local currency or the domestic currency. So whether it's domestic currency or foreign currency is that interpretation is a relative thing. But originally this definition came from US side, European side with the with respect to dollars. But later, now in the market, the standard way of defining the direct quote or the indirect quote is whenever dollar appears as the base currency, then we call it as a direct quote. That's the easiest way to remember. And this, whenever dollar is appeared as the base currency, we call it as a direct quote. So dollar JPY, it's a direct quote. Dollar LKR is a direct quote. What is BDT?
Bangladesh Taka.
Bangladesh Taka. So when I prepare this presentation, indeed 7-8 years ago, I included this currency into the presentation because they are Bangladesh participants. So they were here to understand or learn about foreign exchange market. So, but you can see how even though we don't do directly with in Taka, that is also come to at least the country has some significance in our markets now. Okay, however, have you understood what is a direct quote? The easiest way to remember is if the dollar is base currency, then it is a direct quote. Clear?
Yes, sir.
Yeah, okay. Then if you remember that indirect quote is nothing. That's the other way around. Anything else is indirect quote. when the dollar is not involved, not dollar is in the count as the counter currency, then it is indirect quote. So, but globally, only these 6 currencies are quoted in that manner. Globally, only these 6. Yes, these currencies are quoted in this manner. This is again because of the historical reason that colonial impact. So, and the one thing that I have to highlight in the definition of euro, when they introduce euro, they have mentioned that the euro should be the base currency in any against any other currency. So therefore, you won't see any quote where euro is at the or appeared as a counter currency. Euro will always be there as the base currency. So these are the indirect quote. Dollar is at the counter currency. Then you will come to a problem like JPY LKR. No dollar. Then how do we distinguish this one? When the dollar rate or the dollar is not appeared in the currency pair, we call them the cross currencies. In the global market, when the dollar is not involved, that is called cross currency. But in Sri Lankan context, we use it slightly different manner in Sri Lankan market, but that's the proper way of identifying cross currency. Clear?
Yes, sir.
So it's don't get confused now. We learn few terms, 4 terms in the base currency, counter currency, then direct quote and indirect quote. So you can see the interlinkage or the connection. Base currency and counter currency is linked to the definition of direct quote and indirect quote. So they don't get confused with those. And it's not a difficult thing to understand. Remember that. Then comes to the concept called trade date and settlement date or the value date. I have explained this previously. And this concept is not applicable only for this concept is applicable not only for foreign exchange market, as I mentioned previously. This is applicable for many other markets as well. The trade date and the value date or the settlement date concept. What is trade date? The date on which the transaction occurs. So that means, what does it mean by the transaction here? When you come to the agreement to buy or sell or lend or borrow, whatever. When you define the terms and conditions of the transaction and agreed by both parties, that date is we call the trade date. But no funds have been moved, no ownership is transferred, nothing. Just an agreement between 2 parties. The date which that occurs, we call the trade date. Then we'll move to the value date. The value date or the settlement date is the date that you are going to exchange the ownership or exchange funds or transfer ownership, or basically on the date that you are going to settle the transaction. When are you going to settle the transaction? Transfer the ownership, make the payment, receive the payment. That date we call is the value date. Clear? Trade date and the value date. So two different things. Trade date is the date on which you come to the enters into the agreement. On the value date, it is the date that you are settle the transaction. Supposed to settle the transaction, exchange the ownership. But thing is, the trade date and value date can be on the same date. Today you enter into the agreement and you settle the transaction today itself. That can be the case. Or you enter into the transaction today, you settle the transaction tomorrow. That is possible. Or maybe day after tomorrow. Or maybe in 3 days, 4 days, 7 days. You enter into the transaction today, but you settle the transaction on another day. That's the difference between value date and trade date. But based on the agreed value date, we have given specific names to those, especially in foreign exchange. So in the foreign exchange market, unless you specifically mention, we consider that the value date falls after 2 business days, T plus 2. If you enter into the transaction, assuming today is a business day, if you enter into the transaction today, the transaction will settle not tomorrow, but day after tomorrow in 2 business days. That is the general norm in foreign exchange market. There are 2 exceptions. First one is Canadian dollar and dollar. CAD means Canadian dollar and US dollar. The convention for the Canadian dollar and dollar is the normal settlement takes place in 1 business day. Unless you specified a specific value date, the transaction take place on the, settlement take place on the next business day. But when it comes to Middle East countries, there's a special mechanism called split settlement, because these countries are closed on Friday. If the settlement falls on to a Friday, the dollar leg or the whatever the country or the whatever the currency domiciling out of the Middle East countries will be settled on Friday, but the domestic currency will be settled on Sunday. That is their working day. That is we call split settlement. The transaction is settled on 2 different dates, not on the same date. But in others, you pay or receive dollars or whatever the currency, one currency on the same day as that you pay and receive the other currency. Within a single day, you exchange both currencies. But in a split settlement, one currency is paid or received on one day, and the other currency is received or paid on another date. So that is one of the exception. Otherwise, generally settlement takes place in 2 business days, except for Canadian dollar. Canadian dollar, it is T plus 1. So that settlement in 2 business days, we call it as the spot value transaction. In the FX market, we just call spot transaction. What does it mean? Normal foreign exchange transaction by yourself but it is to be settled in 2 business days, 2 working days after the trade date. So that's the spot transaction. In generally, in the market, all the exchange rates are given in spot, in the wholesale market, not in the retail market. In the wholesale market, quoted prices are called spot rate because assuming that settlement take place on T+2 basis, the exchange rate is quoted. So
Excuse me, sir.
yes,
So can you please explain that split settlement again?
split settlement, yes.
Yeah.
Say if you do a dollar rupee transaction, say assume you buy dollars, sell rupees. If today is the settlement date, you pay rupees today
Yeah.
and you receive dollars today itself, same date.
Okay.
But in a split settlement,
Hmm.
was Middle East countries, some of the Middle East countries.
Let's say AED to USD or
AED,
USD.
yes. Say
Okay.
that market is closed on Friday.
Okay.
So assume your settlement date is falls on to a Friday. You do the transaction on Wednesday, then the settlement falls on Friday.
Friday.
Assume you are buying dollars against AED.
Okay.
Then what do? You will receive your dollars on Friday,
Okay.
but in the Arab, Friday is not a business day; it's closed.
Friday and
So
Saturday they are closed.
they are closed. You can't pay AED on Friday. So
Okay.
instead paying it Friday, you make the payment on Sunday. You receive the dollars on Friday, you pay AED on Sunday.
So won't there be any exchange losses or something? Not for us, for them.
No, because they know that is there. So
Okay.
they do the pricing based on that.
Okay. Okay.
So
Understood.
whenever you quote the price, indicator price, you know that dollar will settle on Friday and the other currency will settle on Sunday. So you know that.
Okay. Okay.
Sir, one question. Do countries' working days effective? So, for example, Sri Lanka Poya holidays, which are bank holidays, would that cause a split settlement?
Yes. So when you decide the settlement date, and when it says 2 business days, it should be in both centers. So after 2 business days of both working business centers, say as you says dollar rupee, if you do the transaction, say this next week Wednesday or Tuesday, if you take this week, coming week, today is
Thursday.
13, 14, 15, 16, 17, 18. Monday, Tuesday, Wednesday, Thursday, Friday. There's a holiday. When?
Thursday.
This is a holiday. Assume that you enter into the transaction, dollar rupee transaction. on 15th. This is the trade date. When should be the settlement date? Two days. It should be on 17th. But 17th is not a business day in Sri Lanka. So therefore, spot date falls on to 18th. Clear? Is it clear?
Yes, sir.
If you do the transaction on Tuesday 15th, 2 business days means 17th. Sorry, 2 days means 17th, but the second day is not a business day. So you ignore this part. You straight away jump to the next business day. So 18th would be the spot date. So a trade you entered into on Tuesday 15th will be settled on 18th Friday. Now let me know if you enter into a transaction on 16th, then what would be the settlement?
18th.
18th. You entered into the transaction on 16th. This is the trade date. What's the settlement date? Again,
21st.
2 business days. So 18th is not a business day. From 16th to 17th, 1 business day. Then 19th, 20th are again holidays. Sorry, yes. Sorry, not 17th is a business day. 17th is not a business day. So you jump from 16th to 18th, Friday. And then again, 19th and 20th are not business days. 21st is the next business day. So you jump straight away to here. Then a spot transaction that you entered into on 16th March, the settlement will take place on 21st March. That is the norm. Clear?
Yes, it's clear.
So whenever we say business days, it has to be on both centers. Business days on both centers, not on one center. So the exchange rate that we quote is basically for to settle in on spot basis. Therefore, we call that rate as the spot rate, and the settlement date we call it as the spot date. In previous example, trade date is 16th, spot date is 21st. 15th trade date, spot date is 18th. Monday, 14th, what is the spot date? 16th is the spot date. So those are the places where we use this spot. Then the TOM. TOM means tomorrow. That means if we enter into the transaction today, we settle the transaction tomorrow, assuming tomorrow is a business day. So TOM is a transaction where you do with the agreement to settle it in 1 business day's time. Basically, to settle it tomorrow if it is a business day. Then the other one is cash. That means the trade date and the settlement date or the value date both are the same. So you enter into the transaction today and you settle the transaction today itself. But in some currency pairs, it is not possible, depending on where are you. If you are in US, if you do a AUD USD transaction, you cannot settle it on cash basis because when US opens, Australia is closed. So they cannot settle the transaction on the same date. Clear? Any question? So basically, in the timeline, cash comes first because you settle the transaction on the same date spot. That's how it goes. Trade date also on the same date, assuming there are no holidays in between that. Is it clear? Any questions?
It's clear, sir.
Yeah. Then comes the word forward. In this, there's no specific settlement date. This is the trade date. This is the spot date. Any transaction that you agree to do beyond this spot date, somewhere here into the future, all those things collectively referred as forward transactions. Value date falls after the spot date, beyond 2 working days. All those things are collectively called as forward transaction in FX market. Is it clear? So it can be T plus 3, T plus 4, T plus 10, T plus 100, T plus 600, whatever. The settlement date falls after spot date. Everything considered as forward transactions. Is it clear? Any question?
So I have heard that terminals called Spotnex.
Spotnex.
Yes, sir.
Yes. That is not relevant for the FX outright transaction. That can be that is relevant for FX swaps transaction. If you can remember the same thing we discussed last week. What is spot next in the money market transactions? What does it mean by spot next? Can someone explain? We discussed that. In the money market transaction, what does it mean by spot next? Can you remember? What is a spot next transaction?
Is it T plus 3 settlement?
Sorry?
Is it T plus 3 settlement?
No. T plus 3 settlement, it's a forward transaction. We discussed this under money market transactions, especially like call money transactions. What does it mean? Spot next. And in these type of transactions, we need two settlement dates, not only one. Say it's like on the trade date, you enter into a transaction to lend or borrow. Either to lend or borrow. When you lend and borrow, how many settlement dates are there? Say you are a lender. The first day is the day that you lend money, give out cash. Then the next settlement date is
When you receive money back.
when you receive money. So in the spot next, what would happen? You lend money here, you receive money here. So you lend money after 2 days, you receive money after 3 days from the trade date. So you just lend money for a 1 day, or you just borrow money for a 1 day. In foreign exchange market, this comes in the swap market. So basically you buy one currency on the spot date and you sell the same currency on the spot next date. You reverse the transaction on the very next day. That's a spot next transaction. So go back and get the idea. We discuss about overnight, Tom next, spot next. Likewise, few different jargons in the maturities. So go back and get some idea, because the same jargons we are going to use in the foreign exchange swaps, maybe in 2 weeks. But then you have to remember that forever. Know that forever. Understand the concept forever. So therefore, same concept applicable in the money market as well as in the foreign exchange market. So same thing. We discussed this trade date concept, value date concept in money market as well. Now we are applying it in the FX market as well. We'll do the same thing in the bond market, futures market. So there can be trade date, value date, maturity date. These concepts will be there. So now we have discussed those. You should know that when it comes in the next time, when it appears next time, you should know what does it mean. So please go back and refresh your knowledge on that. So before we'll move forward on this, shall we take a break here? So we'll move forward with the rest of the terminology. So the next one is the market maker. Market maker is the person or the entity who is giving the prices, making the quotes, and then other side of that is the market taker, who reacts to the market quotes given by the market maker. Who is giving the price, showing the price, is called market maker, and who is acting on that, agree to buy or sell on that price, is called the market taker. So there's a word that two-way quotes will come to that in a moment. What does it mean by two-way quotes? So the two-way quote is the two prices shown by the market maker. Market maker gives you two prices. So he is the one who is pricing. Market maker will tell you, okay, this is the price, or this is the exchange rate in this case, basically. And again, this market maker, market taker, it's not only applicable for FX market, even in the bond market, any other markets, interest rate markets, or money market. This concept is valid. That market maker generally a dealer in the bank who is giving prices to others, showing prices to others. Those who want to do trades, they can deal at that price or enter into a transaction at that price. So in FX, again, this bid or the offer, bid and the offer or the ask. This is again common in any other market as well. So basically, in the two-way quotes, you get two prices. You get two prices. You can see Euro USD. There are two exchange rate, not only one exchange rate. Two exchange rates are given. What are those two? For the same currency pair, there are two exchange rates, bid and the offer. So what is bid? Bid is the price at which the market maker is willing to buy. Market maker is willing to buy. So the bid is the price at which the market maker is willing to buy euro against US dollar in this example. So in generally, bid rate is the price at which the market maker is willing to buy the base currency. Market maker base currency. At the bid rate, market maker buys the base currency. So on the other hand, this is the price that the market taker can sell the base currency. Then what is the offer price? This is the price that market maker sells the base currency. At this price, the market maker sells the base currency. Is it clear? Any question? If not, we'll move forward. Then the exchange rate given in the two-way quote, we segregate that into the same number into two parts, big figure and pips or the points. In this example, 1.36 up to 2 decimal places, we call it the big figure, and 45 is the pips or the points. This rule is correct for exchange rates with 4 decimal places. Just maybe one full figure integer figure, but if we take like Japanese yen, say 110.86, something like this. Sri Lankan rupees, say 265.99, something like this. So in these, the integer part is the full figure. The rest decimal parts are the points or the pips. When it comes to why do we want to know this is when it comes to the market, when you ask for a price, depending on the platform that you use, if it is a voice trade, that means if you do a transaction over the phone or a chat-in type of platform, they may not be able to give you the full number exchange rate like this. The trader will quote just the last 2 digits. That means only the points. Traders will quote only the last 2 digits or the points, because the market is so fast, moves very fast. There's no time for them to type it or tell it the full figure. They just tell just the last 2 figures. Like in this example, the trader may say 45.47. That's it. 45.47. Then you know 45 is the bid, 47 is the offer, and you should know what is the big figure going in the market at this moment. So then in the two-way quote, the other word that we use is the spread. That is the difference between ask price or the offer and the bid. Remember, always offer is higher than the bid. In general market, there are instances in various markets. Bid rate can be higher than the offer rate, but generally, normal condition, offer should be higher than the bid rate, because the market taker is selling at a higher price than his buying price. He buys at a lower price and sells at a higher price. That makes profit to him. So therefore, buy low, sell high concept. So buying price is lower than the selling price from the market maker's point of view. But for the market taker, it is other way around. You sell at a lower rate and you buy at a higher rate. So the difference between ask and bid price, we call it as the spread. Generally, spread is given in number of pips without saying that 0.0002. It says just spread is 2 pips. So the exchange rate given here is 1.3647. That's the offer price. Bid price is 1.3645. So the difference is 0.0002. Basically 2 pips. We know that pips are the numbers given in the 3rd and 4th decimal point. So in this example, spread is just 2 pips. Then though it's not, this is not that much used in the market, but better you know this. Reciprocal code, that is, you can switch the base currency and counter currency in any code. There's no harm, you can do that, but only thing is you have to specifically mention that. Say, we know that Euro USD, that is the general rule, general way that we quote Euro against dollar. Euro is in the base currency, dollar as the counter currency. We can say dollar rupee, USD, dollar is the base currency, rupee is the counter currency. But for some reason, if you need, you can flip it other side. Instead of Euro USD, you can say USD Euro. Then dollar is the base currency, Euro is the counter currency. What is the exchange rate? It is just the reciprocal of the previous code. What does it mean, reciprocal? 1 divided by the rate. Because what does it mean? It's very simple concept. If 1 euro equals 1.4045 dollars, that's the meaning of this, no? 1 euro equals 1.405 dollars. Then what's the value of $1 in terms of euro? This is the symbol that we use for euro. How do you calculate it? If 1 euro is equal to 1.4045 dollars, what is the value of dollar in terms of euro? 1 divided by 1.4045, it comes as 0.7120. That is, we call the reciprocal code. So in that sense, direct code becomes indirect code, indirect code becomes direct code. Then the exchange rate flip over. That is, we call reciprocal code. But when it comes to two-way codes, there's a trick. Say, this is the two-way codes for the euro dollar. Bid is 1.4045. What does it mean? Market taker is willing to buy euro paying 1.4045 dollars per euro. Meantime, he is willing to sell euros by receiving 1.4047 dollars. But what would happen when you flip it? Say 1 over 1.4047, the answer is 0.7119. 1 over 1.4045 is 0.7120. Now you can see this was the offer. When you flip it or take the reciprocal, the answer is lower than when you take the reciprocal of the bid. Why? You divide 1 by a small number and 1 by a large number. When you divide by the large number, you get a small number. You divide by a small number, you get a larger number. So mathematically, that's what happens. So therefore, reciprocal of the offer becomes the bid. Reciprocal of the bid becomes the offer. But still, economically or practically, what the market maker agrees, there won't be any change. Now what is agreeing? To buy dollars again euro at 7119. That means for $1, the market maker agrees to pay 0.7119. It is same as to buy to sell dollar. He wants, to sell euro, he needs 1.4047 dollars. Same thing. So in this, market maker agrees to sell dollars by charging 0.7120 euros per dollar. So that's how you calculate reciprocal exchange rate, especially with bid offer. So then you have to not only take the reciprocal, change the bid over position as well. Any question so far? So then we'll move to the cross trades. I mentioned this, where dollar is not appear in the currency pair. That is we call cross trade. There's no dollar involvement in that exchange rate. Two other currencies are involved. But normal practice is to construct a cross trade where the stronger currency as the base currency in that pair. So stronger currency becomes the base currency, the weaker currency as the counter currency. That's the general or the normal market practice to construct cross trades. So in this, again, we can have three different combinations, because we know that we have indirect quotes, direct quotes. So there can be combination. There can be two exchange rates which are indirect quotes. Then we need to calculate the cross rate. That means take out dollar part, then what is the exchange rate between other two currencies. Or there can be two direct quotes. Then how do we do it? In the third one, there can be one direct quote and one indirect quote. Then how do we do that? So just to explain what is cross currency, something like this. We know USD LKR rate. It is there. Then there's exchange rate for Euro USD as well. Then take out dollar. What is the exchange rate between Euro and LKR? That is cross currency. At the beginning, you saw that JPY LKR. No dollar involvement. It can be Euro Swiss franc. No dollar involvement. So how do we calculate these exchange rates? Given we have the exchange rate of these currencies against dollar. We have euro dollar exchange rate, we have dollar CHF exchange rate. Then how can we get the euro CHF exchange rate? That is meant by cross trades. Is it clear? So in that, you would see different type of currency pairs. Here, dollar LKR. Is it a direct quote or indirect quote?
Direct quote.
It's a direct quote. Euro USD?
Indirect.
Indirect quote. If we take dollar yen?
Direct.
Direct. Dollar LKR? Direct. So then how can we derive yen LKR? So in this pair, euro dollar, indirect. Dollar CHF, indirect. Then how can you how do you calculate that? What about this? Euro AUD. Or Euro GBP. Both are coming from two indirect, sorry. Yes, both are coming from two indirect codes. How to get that? So these three combinations we are going to discuss. The first one is when you have two indirect codes, then the rule, you can remember this way, then the rule is divide across. You have a bit of a two exchange rates. In this example, Euro dollar exchange rate and GBP USD exchange rate. As I mentioned, always Euro should be in the as the base currency. But in this case, if you see that the stronger currency is sterling, but in that Euro case, it's an exception, because in their introduction definition of Euro, they say it should appear always as the base currency. So with that, only the currency has accepted. So therefore, we have to follow that convention. So Euro USD, this is an indirect code. Then you have two codes, bid and offer. GBP USD, again indirect code. You have two codes, bid and offer. With this, how do you derive what is the bid for Euro GBP? What is the offer for GBP, Euro GBP? What you do, first take the currency or the currency pair against, or the exchange rate against dollar, which should be the base currency of the new currency pair. So that means Euro GBP, this is the new currency pair that we want to derive the exchange rate. The base currency is Euro. Then what is the currency pair? We need Euro USD. We consider Euro USD as the numerator. That's what it says, numerator base. Then in the denominator, we have the other currency pair, GBP USD. So Euro USD rate divided by the GBP USD rate, you get Euro GBP rate. But again, when you do that, what do? You don't straight away divide bid by bid and the offer by the offer rate. Instead, you divide the bid rate by the offer rate to derive the bid rate. And offer rate by the bid rate to get the offer rate. You do this when there are two indirect codes. This is sort of mechanical. Why do we do this? If you go back and think it, I think it would be easy for you to understand what are we doing here. So if I move to the board, is it okay? You can see. Shall I stop sharing? Now you can see the board properly. Is it? Can you see the board properly?
Yes.
Yes. Okay. You can see here. Can you see?
Yes, sir.
So Euro USD rate is 1.4045. GBP USD rate is 1.599598. Now what we need to find euro GBP rate. To explain this first thing, why do we divide this? I just forget about it. Forget about this dividend of first. I just take one rate 1.5998. Forget about this dividend. Why do we divide this? First, we'll try to understand why is that. What does it mean? This one, 1 euro equals 1.4045 dollars. Correct. Then the second one, 1 GBP equals 1.5998 dollars. What we want to find $1 in sterling pound. Sorry, 1 euro in terms of sterling pound. This is the figure that we want to find out. Forget about this exchange rate, everything. If you know this, how to get this figure. You know what one of something is this much of the other thing. The one of the second, the third thing is this much of the second. What you can do, you want to keep this as it is 1. Now, if you can find what is the value of $1 in terms of sterling, then you know 1 euro is this much of dollars. Then you can calculate what is the value in sterling. So therefore, we calculate the reciprocal. That means we calculate value of $1 in terms of sterling. What is the value of $1 in terms of sterling? It is 1.5998 sterling. Then this is the value of $1 in terms of sterling. But 1 euro is this much of dollars. Then what is the value of 1 euro? 1 euro equals 1.4045 dollars, but $1 equals 1 over 1.5998 sterling pound. When you multiply these two, you get the value of euro. Sorry, this is value of euro in terms of sterling pound. That is 0.8779. Euro-dollar exchange rate divided by sterling pound dollar exchange rate. That's how we calculate the cross rate. Now, why do we have to cross that? Then you know, when you calculate the reciprocal, you have to cross it. Bit of a, when you take the reciprocal, what becomes the bit? Which becomes the upper of the reciprocal. So that's why we use that. We have to use the reciprocal. When you use that reciprocal, we just cross the original bid and offer. You get the reciprocal exchange rate. That's why, to simplicity, without going through all these steps, to make it easy for fast calculation, this has come as a like a rule. Cross division across means, sorry, cross division means, when I say cross division, no need to say across. Cross division means you change the bid and offer in the denominator, not the numerator. You select the numerator exchange rate as the currency which involves the base currency of the new currency pair. That's how we calculate the bid and offer. So you can try with any two indirect quotes, but we have to do the same thing. Then we'll move to the second combination. When you have one direct quote and one indirect quote, again the same concept you can use, but it is very straightforward. Therefore, what you have to do, multiply bid with the bid, offer with the offer. So that's why it says straight down and multiply. Bid rate with the bid rate, offer rate with the offer rate. So there's no numerator or denominator. You just multiply it. But remember, the strong currency becomes the base currency. So therefore, in this pair, Australian dollar is the stronger currency. So Australian dollar becomes the base currency, yen becomes the weaker currency. Clear? Any question? The third one, when we have two direct quotes, but still it is a division, divide across. Only difference here is, now this time numerator is the counter currency. You take the counter currency exchange rate at the numerator and the exchange rate of the base currency at the denominator. Then follow the cross division, because whenever you do the calculate the reciprocal, you need to do the crossing. That's how you get the cross rate of the two direct quotes. Canadian JPY bid is 81.53, Can JPY offer is 81.62. Remember, first thing, you have to identify whether this is a direct quote or indirect quote. Second thing, you have to identify what is the base currency of the new pair, especially when it is in the same quote, kind of quotes. That means whether it's two indirect quotes or two direct quotes. If it is a combination of direct and indirect quotes, very simple, just multiply bid by bid, offer by offer. But if it is same type of quotes, that means two indirect quotes or two direct quotes, then you have to identify what is the base currency and what is the counter currency. What is the exchange rate that we have to place in the numerator? What is the exchange rate that we have to put in the numerator? Identify that. Then remember to cross the bids and offers in the reciprocal currency. Then perform the calculation. Make the do the division. Then you get the answer. Once you get the answer, check whether your bid is lower than the offer. If not, something wrong. At least that way you can do a check whether it is correct or wrong. Is there any problem in these two codes? Something wrong? Can you see that? Sorry. No, this is the division. This is the answer. Yes. Then bid is lower than the offer, so this is correct. Bid divided by offer 9843. Offer divided by bid. Sorry, offer divided by bid. 8030 divided by 9838. So these are the two answers that you get. Then the other thing, by looking at these two currency pairs and the exchange rates, you should be able to identify whether your answer would be more than one or less than one. Whether you get a decimal figure or you get a only a decimal figure, or you get a integer number which is more than one. Say if you go back this, euro exchange rate against dollar is 1.4 and the sterling against dollar is 1.59. So the rate sterling rate is higher than the euro rate. So therefore, when you place euro at the base, you divide by the sterling rate, then therefore the resulting exchange rate should be less than 1. It can't be 1 point something or 10 something or 80 something like that, because you divide by a larger number. In multiplication, definitely you won't get wrong, but again this division, now think, you divide a big number by a small number, then the answer should be a integer with the integer part, and the exchange rate should be more than this, more than 80 something, because if you divide 80 by 1 you get 80. If you divide 80 by less than 1, 0.98 or 0.9, 0.8, you should get an answer more than 80. So that is another thing that you should be able to identify. Just by looking at the numbers, you should be able to tell, okay, the resulting exchange rate, the cross rate, would it be higher than the highest exchange rate appear in this pair, two pairs, or less than that, or in between that. Find out some currency pairs and do some calculations by your own and try to identify these relationship. Any questions? Any questions? You don't have any question? Okay, let's see. I'll stop sharing and we'll move back to the board. Now, answer. Euro USD 1.4045. This is the exchange rate. Now, assume it went up to 4098. From this exchange rate 1.4045 to 1.4098. What has happened to euro? What has happened to euro?
Euro has gone up, appreciated.
Euro has appreciated. Euro has appreciated. Then dollar.
Depreciated against euro.
Yeah. Depreciated against euro. So this is very important. Even here we have to say euro has appreciated against dollar. So there are two currencies in one exchange rate. So therefore, when the exchange rate goes up and down, one currency appreciates while the other currency depreciates. So this is a relative movement. Therefore, you have to mention that against what? Appreciated against what? Depreciated against what? Okay. Now, what has happened to Euro USD exchange rate? Euro USD exchange rate from 1.4045 to 1.4098. Euro USD exchange rate has increased. Correct. Exchange rate has increased from 1.4045 to 1.4098. Exchange rate has increased. When that happens, one currency appreciates, other currency depreciates. What is the currency appreciates? This is an indirect quote. When the exchange rate increased, base currency appreciates. Then opposite is counter currency. So that happens when the exchange rate increase and the currency pair is in indirect. Clear? Then now you should be able to identify the difference between exchange rate increase and the appreciation or the depreciation. It's not that exchange rate increase always meant that the currency appreciation or currency depreciation. That depends on where are you. What is the currency pair against what? So whether it's in the indirect quote or indirect quote method, and whether exchange rate increase or decrease, always one currency appreciates against the other. What is the currency appreciate? What is the currency depreciate? Will change. say this example, interest rate increase, euro appreciated, dollar depreciated against other currency. Other currency means euro appreciated against dollar, dollar depreciated against euro. If it goes down to 3950, then how do you put it? Exchange rate decrease. What is the currency appreciated?
Dollar.
Dollar appreciated against
Euro.
euro
Depreciated.
depreciated against dollar. Sorry. Yes, euro depreciated against dollar. That's how it works. So therefore, appreciation, depreciation, rate increase, decrease. Be careful when you use these jargons and be clear on that. So now we'll take another example. The dollar yen exchange rate is now at $110.25. Assume this goes up to 111.05. What has happened? Exchange rate increase. Correct? 110.25 to 111.05. Exchange rate increase. What has happened to dollar? What has happened to yen?
Dollar appreciated against yen.
Dollar appreciated against yen. What has happened to yen?
Depreciated against dollar.
Depreciated against dollar. If this comes down to 110, exchange rate went down, dollar depreciated against yen, and yen appreciated against dollar. So no need to tell both sentences. When one is said, other is implied. But for clarity, I wrote both. Is it clear? Any question? We had euro, USD, 1.4045, and I mentioned that it is gone up to 1.4095. Okay, see, 95. From here to here, this is also here to here. Now what's the situation? What has happened to dollar? What has happened to dollar?
With JPI, dollar appreciated. With euro, dollar depreciated.
Yes. Against euro, dollar depreciated against yen, dollar appreciated. What would happen to euro JPY? Calculate and see when this was at these levels, what is the euro JPY? Case 1, and what is the JPY rate? Euro JPY rate at, in this instance. See what has happened, and try to change these amounts in different by different amounts and see what is the impact. So dollar has moved in two different ways against two different currencies. So the impact, it can be euro might have appreciated against yen, or might be yen has appreciated against euro, or it may be there's no change. Everything depends on the relative movement in these two pairs in this particular combination, because it's a one is indirect quote, other one is direct quote. It's a multiplication, but you should be able to tell it what would happen if it is a direct quote and both currencies are in direct quotes, or both pairs are in indirect quotes. So with few different numbers, try it and see what is the net impact. Any question? Any question? No. You will answer me this question. Say euro USD. No. AUD USD. In the given example, the exchange rate was quoted like 9.5. 9295 98, something like this. Okay, forget about that. What are the exchange rates? What is the bid? What is the offer? What is the bid exchange rate? 1 AUD equals this much of USD. Offer 1 AUD equals this much of USD. What is that? What is X? What is Y?
Bid is 0.9295 and the offer is 9302.
What is 9295? Bid.
Yeah, bid
Bid is 0.9295.
95.
The offer is
0.9302.
0.9302. Yes, correct. That's how you read. So basically, if you ask for a price, the party may quote like 9502. Then you should know that now you can see bid is higher than the offer. Bid is higher than the offer. I mentioned that this is not the general condition in the foreign exchange spot market. In shops, yes, there can be instances like that. We'll come to that. But in the spot market, this can't be the case. What does this reflect? Especially in this border case, 95, 90 means you are at a border case, about to change the big figure. So, what is the big figure here? In the bid side, bid figure is 0.92. So therefore, when the other side is low and less than 10 figure, generally, what does it mean? You cross over the big figure to the next level. So therefore, this side big figure is 92. This side big figure is 93, and pips are 95 and 0. So whenever you see this type of course, you should realize that as clear. Any question? Okay, now you know about most of the jargons they use in the treasury in FX market. Yes. Okay, then shall we move to the other presentation then? So we'll continue with foreign exchange. This is about spot trading. That means you just trade on the spot market. This is just to give you some practical view or get some knowledge on how practically this thing would happen. Market maker, market taker, I explained that earlier. Market maker is the one who provides quotes to the market, generally a market or the dealer bank in the market. Market taker is the party who is asking for a price and who who is willing to deal at the quoted price. Okay, this summarize what are the actions of the market maker and market taker at the bid price and the offer price. So in this instance, remember, market maker buys the base currency at the bid price. Market maker buys the base currency at the bid price, no matter whether it's a direct quote or an indirect quote. Don't get mix up with that. It doesn't matter whether it's a direct quote or indirect quote. It doesn't matter. Market maker always buy the base currency at the bid price. Okay. So on the other hand, market maker sell the base currency at the offer price. So the opposite for the market take. So here you can see buy base, opposite is sell base. Market taker sell the base currency at the bid price. Market taker buy the base currency at the offer price. That has to be clear. This is then when you want to trade. This is one way of doing this. This is a screenshot of a sort of an electronic trading platform, multi-party trading platform. Here you can see exchange rate for many currencies and by many parties. So these are the different banks quoted for these currencies. So all these parties are market makers from the perspective of the whoever the party who is looking at this screen. So if I am looking at this screen, all these parties are market makers for me. I am the market taker. I am going to trade with them, any one of them. So I am the market taker. These are the market makers. Now we'll just concentrate on the euro dollar exchange rate. This is the screen you might see on Bloomberg to trade foreign exchange. So you can here select the currency pair, then enter the amount. Remember, if you don't change this currency, it will by default would be base currency. If you want to convert it into dollars, yes, you can ask the amount in dollars, but the currency pair euro dollar. Here the amount is, if you don't mention specifically, the amount that you mention is again in the base currency. But if you want to mention it in the counter currency, you can make it, change the amount. Then whether you need the spot price or a term price next or a forward price giving the settlement date, you can do that. But this is for the spot price. This is the spot date, value date 2014 June 6th. So what is this? This is the bid price. This is the offer price quoted by this particular bank, HSBC. 1.36105, 1.36111. You can see generally we think the prices are quoted only for 4 decimals, but due to high competition, high liquidity, now they have moved to the 5th decimal even. So they just differentiate the figures at the 5th decimal place. This is the quote by HSBC. This is the quote by Standard Chartered. This is Citi. So by looking at these figures, if you want to buy euro, what is the rate that you select? just concentrate on these parts and let me know what is the rate that you execute the transaction if you want to buy euros. You are a market taker in this instance.
JP Morgan.
JP Morgan with that party. What's the rate?
It should be TD Securities 1.36101. Since that's the lowest rate.
1.36
101 of TD Securities.
101.
Yeah.
So you are referring to this.
Yes.
Any other answers? I didn't get any clarification from the whoever who said that JP Morgan is the party.
I was actually looking at the buying rate. So the lowest is JP Morgan. So yeah.
So what's the buying rate?
1.36110.
This is the lowest rate.
Yeah.
You are referring to this side.
Yes.
Okay. Any other answers?
We can go to Standard Chartered. They offering at 1.36109.
JP Morgan, I'll select different color. This is one of the answers. The other one said Standard Chartered. Why?
Yes, 1.36109.
1.36109. That means you are referring to this rate.
Yes.
Okay. Any other answers? Okay. Now, any other answers? Okay. Now you can see you want to buy euro. Someone is trying to trade at this side of the course. Someone tries to trade at on the right hand side of the course. Which one is correct? That both cannot be correct. No, that's obvious. Forget about the rate. First select the side, whether you should go for left side course or the right side course.
We should go for the left side because we are buying euros. Here the codes are like they are selling euros. Since we are buying, we should go to the left side.
We are buying euros, so therefore we should go for left side. Others, any is it correct? Any other? Okay, go back. Are we market makers or market takers?
We are market takers.
We are market
Takers. We are buying. Yeah.
So okay, not because of we are buying, we become market takers.
Okay.
We are going to act on someone else's course.
Okay.
So that's why we become market takers. We market takers. So market takers, are we buying at the bid or the offer?
We are buying at offer.
We are buying at the offer. As market takers, we are buying at the offer. Which one? Base currency or the counter currency? That is also important.
Base currency.
Yes, we are buying base currency at the offer or the bid. If you are not sure, you can go back.
Offer.
Read it. As market takers, we buy the base currency at the
Offer.
offer.
Okay.
So then, what is offer? What is bid? This side is bid. This side is
Offer.
so we buy at one of these rates. So
Okay.
when we try to buy, are we paying the highest rate or the lowest rate?
Lowest rate.
Highest price or the lowest price?
Lowest price.
We try to pay the lowest price. Now the thing is, go through these numbers and find out what is the lowest number.
Two banks are offering the same, Standard Chartered and then Bank of America.
Yes. So,
So we can
1.36109, 1.36109 is the lowest offer that we
Yes.
get.
Out of this.
So therefore, we
We
should
can
trade at that rate. Whether you select Standard Chartered or Bank of America, that it's a different thing. But you should trade at this rate.
Okay.
Okay. If you want to sell, then you switch to the other side, bid side. And at the bid side, do you select the lowest figure or the highest figure?
Highest bid.
Because you are selling, you need the highest price. So therefore, go for the highest price. There are three parties quoting the highest price. So the easiness of this electronic platforms is, so depending on the provider, service provider, that may features may vary, but in this at least you can see there are two quotes, no party is given here. What is this? This row shows the best bid and the best offer. So we call this is the market. These all are the market participants that I can see. So therefore, for me, this is the market. What is the best bid and what is the best offer? What does it mean by best bid? Highest bid quoted. What is the best offer? Lowest offer quoted in the market. So therefore, we call this is the market. Even you call a broker for an exchange transaction, they might say market is at 50-52. 50-52. What does it mean? You can get a bid at 50, offer at 52. That's the best that you can get. That is we call that's market. So the good thing here is it is given here. Or and not only that, they have highlighted in this best bid and offers. Either you can selectively click on this one of these parties to whom which you want to trade, or if you are indifferent with the party, whatever sell you can sell depending on whether you want to buy or sell. Say you want to buy, you just click here, the trade will execute. Again, the configure based on the configuration, whether you need double click or single click, you can configure the system. But just by clicking, you can execute the transaction. So that is the easiness of the and numbers you can see visible. It is easy for you. But if you pick the phone, he would tell something 50-52, something like that. Then you should be able to completely correctly figure out what are the numbers that he told you. So not only that, if we are to do a trade on the phone, you have to communicate it very clearly. Otherwise, there will be conflicts at the end. Even on the phone, you can do the trade, but in this sort of screens, it is easy, and you can see many prices of many parties and execute the trade. This is one way of doing, but this is the now the trend, electronic trading platform. So no need to have brokers. So I think with the time, broker's role will disappear. So this is another way. Now I'm not sure this is available. This is sort of a kind of chatting through Reuters. Now even Reuters now provide something like this streaming facility. But here you can specifically call a particular bank and ask for a price and get the quote and agree to a transaction. So this is a still typical transaction. So you don't waste time when you come to execute, especially a foreign exchange transaction, because markets move very fast. So even in this crease, before you move the cursor to here, price might move. Or if you can see this real time, you can see it's like a blinking everywhere because figures are changing. So that is so fast. So therefore you can't waste time. Just type what is the currency you need, what is the amount. AUD 5 million. Then the other party knows we are asking for a quote for Australian dollar against dollar. If you don't mention the counter currency, it is dollars. If you say euro, euro dollar. AUD, if you ask just JPY, the base is dollar JPY. It's given. No need to say USD JPY. Just put JPY, they know. But if you need euro JPY, then you have to say euro JPY. Otherwise, it's against dollar. Just mention that. See the reply, just 1570 bid and offer. Then we have to decide whether I'm buying or selling it. Very quickly, short and sweet, say I buy. No need to say I, even buy would be enough. So that means I have to tell what is my action. So nothing, then straight away the other party, counterparty, gives his settlement instructions. Where to pay dollars. What is the account? What is the value date? Then we are confirming the transaction. See, now you can see the big figure is there. To make sure that we got it correctly, we type it. This part you can do it leisurely. No need to hurry. But the moment you do this and we type this, other party enters this, the transaction is concluded. You can't now go back and say, no, hold. No, you can't do that. Even in this chat inbox, you can't delete whatever you type. You can't, there's no backspace. If you did a mistake when type, you just put some E series of E's, then they know that's something wrong, erroneously typed. You can't delete anything. So that's it. We give our instructions. We are to receive our Australian dollar. The transaction is concluded. It can't take a minute sometimes. So that's one way of doing that. So these are different ways. Or you can, I think there's a voice trading. If you pick the phone how to do this. If you are on the phone, first thing you have to introduce by yourself. Because the other party, maybe nowadays we have CLI and things, they might know this is the party who's calling us, but still both parties give a small introduction. Okay, I'm so and so calling from this party. So then quickly, market taker, this MM means market maker, MT means market takers. Okay, Aussie dollar 10, no need to say this part indeed. Aussie for 10 million. Then they know that asking for Aussie dollar 10 million for 56.61. This is verbal voice. You don't see the figures 56.61. Then you should be straight away identify the two figures, and you are buying, okay, 61, or you can say buy 61 or mine. You can use different jargons, but there are standard set of words. You can use any of these. You can say to buy, you said it buy, mine, or you just indicate the number. Done at 61. Then they know what are you going to do. So then the market maker confirm that you are buying 10 million at 6761 for value spot. That's it. That's how you do trade in the real market. So these are sort of words that we can use based on these codes. Either you, if you want to buy, you can say I buy, or the buy, simply buy, mine, 61 done, or I take, that means you are buying again. Or if you want to sell, you can say I sell, or yours 56 and I give, something like that. But if you don't happy with this code, you can say nothing done, thanks. Then there's no trade executed. But if you use any of these, there is an trade executed trade. So that's how we execute the transaction. So we'll go back to this screen again. Euro dollar, 5 different quotes from 5 different parties. What is the best trade if you want to buy? What is the best trade if you want to buy?
Barclays, 3612.
12, yes. Whenever you say buy, forget about the left hand side, concentrate on the right hand side, go for the lowest figure. Whenever I say sell as a market taker, go to the left hand side, go for the highest figure. If you want to sell, what is the best?
JP Morgan, 3611.
11. Simply at 11. You can sell at 11. What is the market?
Market 11.
11 is
11 and 12.
11, 12. Market is at 11. Market is at 11, 12. See, the spread is only 1 pip. If you go back to this, you can see the spread is, it is at the 5th decimal place and just 3. When the market is so liquid, the spread becomes very narrow, very thin. So that's one of the indicators in the market to see whether markets are liquid. The price difference between bid and offer would be very narrow. When the markets are very liquid, if you go to the market these days, in domestic foreign exchange market, you can see I saw 50-60 to 52-60 were the codes, I think. So if we go back few years back, it may be maximum 5 rupees or 2 rupees even. Some days it may be less than 1 rupees. So that reflects the liquidity in the market. So not only in the FX market, even in government bond market or repo market, wherever, if the spread narrows, that means there are liquidity. There are a lot of buyers and sellers, those who are willing to trade these. And assume you are a market maker. You are a market maker, euro dollar. This is the quotes you can see in the market. 3611, 3612. Now you think euro will strengthen. Euro will strengthen. What do you do? That means euro going to appreciate. What do you do? This is the market code. You are a market maker. You can put your own code. What do you do?
Increase the offer.
Increase the offer. That means you make it as 11, 13.
Yes.
What would happen? Okay, if you
For
think,
my euros, I will get more USD.
okay, if you think one currency is going to appreciate, what do you do?
Keep it.
Keep it. If you have, you keep it. Yes. As a trader, what do you do?
We buy more.
You may buy. Yes. If you are an aggressive trader and you think the currency is appreciate, you should buy. So to buy that, what do you do?
Increase the bid dose.
You
Reduce
just increase the bid. Asking other parties to sell euros to you.
buy. Okay.
Encourage others to sell. So if you put 12, 13, what would happen?
The others will send more currencies to you.
This is your code. What would happen? Market becomes 12, 12. Because your bid is 12, other party best offer is 12. Market becomes 12, 12. So whoever who look at the market, okay, they think, okay, I should sell at 12. If there are buyers who wants to buy, they will buy at 12. Don't worry, you get. If possible, you make it 13. 13, then it would become 13, 12, other way around. But still, people will unload you. When others see this, they will also try to increase. That will bid up the market. Bid will go up. It is followed by the offer as well. So that's how you share in the bid. You take the market up if you think the currency is going to appreciate. You do other way around when you think currency is going to, or base currency is going to weaken. Then what you want to do? You want to sell. So encourage others to buy. So you lower the offer. So then others will buy from you. You can sell more. And when the exchange rate goes down, you can buy it back and make a profit. That's how you trade as a market maker in the market. Is it clear? So when you quote, you should be clear about what is your intention, what you want others to do. You encourage others to do something that what you want. If you want others to buy from you, okay, lower the offer. If you want others to sell to you, increase the bid. So when you trade in the trend in market, that you have to follow these strategies. Any questions? So we'll stop, and next week we'll discuss about the long position and short position, how to calculate the mark-to-market profit loss, and then forward transaction and so on. Any question? Any questions? Okay, then if you don't have any questions, we'll stop here. Thank you very much. And again, I urge you to revise the things that we discussed before you join the next session. It will help you to understand the concepts that we discussed, because all these are interconnected. Thank you.